Hello, in Chapter 5, we're going to be discussing risk and return and portfolio management. So let me go ahead and start this slides here. So there's basically, as we mentioned before, there's two ways to make money in the stock market: through capital appreciation and income meaning dividends plus your capital gains. So if you buy low and sell high, you're going to get a capital gain. And when you think about, if you add in the dividend income plus the capital gain, it includes your total return. So there's some differences in the way we talk about return. The expected return is the return that you expect to get on the stock. So for example, let's say that you look up Apple on Yahoo and you see, look at all these different analysts, and you look at the average of what the analysts are saying. So based on economic conditions and earnings and looking at the fundamentals, these analysts expect Apple and any particular stock to have a particular return. So just think of the expected return as the forecasted return. The required return is the return that you require based on the riskiness of the stock. The riskier the stock is, the higher your required return. And one way that we measure risk is with something called beta. Hopefully you remember this from Finance 302, but we're going over it again in this chapter if you're a little bit rusty. So we use something called the capital asset pricing model, which incorporates beta to calculate what the required return is. Then you can compare the required return with the expected return. And if the expected return is higher than what you require, then you should buy that stock. It's undervalued because what you require is actually less than what they're expecting. If they're equal, they're in equilibrium, you would still buy the stock. But if the expected return is less than the required return, then we would say that the stock is overvalued and you would not purchase it. Okay, then finally, the realized return, that's what the return that you've actually received. Let's say you calculate it at the end of the year. And so that's what you actually get, because of course, you may not get exactly what the expected return is or what's required. And so just to sum up, the expected return is, the best way to sum that up would be to say that's the forecasted return. The required return is the return that you need to be compensated for your risk. And the realized return is the return that you actually end up receiving. Now, when we talk about risk is the probability of a low or a negative return. And there's two sources of risk. There's diversifiable risk, which is also called unsystematic risk. That's risk that can be diversified away if you buy a portfolio, if you invest in a portfolio of stocks or a portfolio of different funds or equities. Non-diversifiable risk is also called systematic risk. So think of that as risk associated with the economic system or the system in general. That's non-diversifiable. So an example of non-diversifiable risk might be a downturn in the economy, a terrorist attack, just anything that affects all stocks in general. That can't be diversified away. So it's called non-diversifiable risk or systematic risk. The COVID outbreak, perfect example of non-diversifiable risk. Or what happened to, of course, the downturn in stocks as a result of COVID. All right, so this is just explaining unsystematic, diversifiable versus systematic, non-diversifiable risk. And they're giving you some more examples of what non-diversifiable risk can be. All right, so you can diversify away unsystematic risk. You cannot diversify away systematic risk. This is showing how if you invest in individual stocks, you're taking on a lot more risk. So you have stock A here, it's gone down and up and down and so forth. But if you invested in a composite of all these stocks, this is a portfolio of stocks A, B, and C, you see that you've minimized your risk. You've taken a lot of the variability out of your investments by investing in this portfolio. All right, so we went over that. Okay, so just to repeat, diversification will not reduce your systematic risk. It can only reduce your unsystematic risk. Now, this is a chart showing the risk of owning one security. So if you invest in one security, this is your risk. You've got all this unsystematic risk or diversifiable risk, and you've got the systematic risk. And the way they measure the risk of, one way to measure the risk of individual equities is by calculating their standard deviation. If you're going to measure risk and compare it to the market in general, that's when we use beta. So beta is really the better measurement. But when we're talking about in this chart, they don't show it here, but this would actually be, the risk would actually be the standard deviation. So let's say, for example, a stock had an expected return, an average return of say 15%, but a standard deviation of 20%. That would mean that if you were within one standard deviation, on average, you would make 15% plus or minus 20%. So so the market in general actually, or individual stocks in general, have a standard deviation of about 32%. So let's just say that this is the standard deviation of 32%. So if we invest in one stock, we've got this standard deviation of 32%. Meaning that if we're within one standard deviation, we can make our expected return plus or minus 32%. So you can see how risky that is. Now, if you invest in two stocks, presumably that aren't positively correlated, we would lower our risk. So if we keep reducing our unsystematic or diversifiable risk, the more stocks we invest in. And basically when we get to about 20 different equities, we've gotten rid of all of our unsystematic or diversifiable risk. So if you are a small investor and don't have enough money to invest in 25 to 40 different equities, you can buy one mutual fund. And a mutual fund is a company that pools people's money and invests in all different kinds of stocks. You would already be diversified. So anyway, you see, once we get down to around 20, we're diversified, but we still can't get rid of the systematic or non-diversifiable risk. Okay, so as I mentioned, the variability in returns, they explain that using the standard deviation, but for individual equities, when you purchase individual stocks or when you're looking at individual stocks. But a better way to look at the risk of a stock is to look at the beta, which is the volatility of returns in relation to the market. So the way they calculate the beta is they do a regression analysis. So let's take Apple again, for example. They will look at the weekly returns of Apple for, say, the past several years, and they'll compare that with the weekly returns in the market. So let's say that the market has a beta of 1. So if Apple performs exactly how the market is, or if any stock individual performs exactly how the market is performing, in other words, when the market's up by 1%, that stock is up by 1%. When the market's down by 1%, that stock is down by 1%. Then that stock would have a beta of 1 because it's equally as risky as the market. If a stock, let's say that Apple tends to move up when the market's up, it tends to go higher. When the market's down, it tends to go lower. Then Apple would have a beta of greater than 1. So any stock that is more volatile than the market will have a beta of greater than 1. If a stock is not as volatile as the market, not as risky as the market, then it's going to have a beta of less than 1. So anyway, that's one, and we use beta, as I mentioned, to calculate the required return. So here's just an example of stocks and riskiness. So we see here that both of these stocks have an expected return of 15%. So that means that on average, they're going to make 15%. You can expect to get a 15% return on these stocks. However, in any given year, you could make as much as 16.5% in this stock, or lose as much as 12, 14, 13.5%. I'm sorry, this is all positive. So the range here is from 13.5% to 16.5%. So this is not a very risky stock. Stock B, you could make 19% or only make 11%. Neither of these stocks are really very risky because they're not even showing a negative return. But in any event, stock B is riskier because it has a wider distribution. All right. So the standard deviation, or how risky a stock is, depends on the variability. It can also depend on the weight in the portfolio. When we talk about the standard deviation for an entire portfolio, it depends on, of course, how risky your individual stocks are, what the standard deviation is on the individual stocks. It also depends on how much you have of that stock in your portfolio. So if you had 80% of a very risky stock, then your portfolio standard deviation is going to be higher relative to another one. And then also the covariance between the two assets, let's say you have a 2-stock portfolio, the covariance between those 2 stocks will also make a difference in your risk. What the covariance is, how the 2 stocks move together. And when one calculates the covariance, you're not, the number doesn't matter. You're looking at the sign. So if the covariance between 2 equities is negative, it means that you're going to get pretty good diversification benefits from them because they move in opposite direction. When one is up, the other's down. If the covariance is positive, then you know that you're not going to get the diversification benefits. So the covariance doesn't tell us the magnitude of the difference. It just tells us the sign, whether it's negative or positive. But we use covariance to calculate something called the correlation coefficient. The correlation coefficient is just the correlation between 2 stocks. It ranges from -1 to +1. -1 meaning perfectly negative correlated, +1 meaning that the 2 assets are perfectly positively correlated. So when you're trying to build a diversified portfolio, ideally you want to try to find assets that are as negatively correlated as you can. That's very difficult to do. But for example, if you're trying to build a diversified portfolio, if you bought companies, stocks in the same industry, you're not going to be diversified. If you bought ExxonMobil and Chevron, you're not getting really any diversification benefit from that. But if you bought ExxonMobil and then some Apple, Dollar General, if you bought stocks in all different industries and tried to purchase stocks that have a low correlation, then you would get maximum diversification benefits. So one example is a lot of people will buy what they call defensive stocks to diversify a portfolio. So, and that doesn't mean the defense industry. That means stocks that are defensive and that they don't go down by as much as the market does in general when the economy goes down or when there's bad news. So the way to think about defensive stocks is to think about what are people going to still buy or still do if there's a recession? Well, they're probably still going to go to Walmart. Okay. They're still going to buy food, although it's maybe not the most expensive brands, but they'll still go to Walmart. They're still going to buy gas. They're still going to buy tobacco. Still going to probably go to McDonald's or cheaper restaurants. Probably still go to Dollar General, those kinds of things. Still buy medicines. So Johnson & Johnson is a good defensive play for pharmaceuticals. Altria is a tobacco company. The ticker's MO. That's a good defensive play. So when you're thinking about diversifying, think about those kinds of things. Also, people will buy REITs, REIT. That's a mutual fund or an ETF. That's a real estate investment trust that invests in commercial real estate. So if you want, because typically real estate tends to move in the opposite direction, or is not as volatile as the market in general. And then people who really want to try to diversify will buy gold and silver, buy precious metals. Most of the time, gold and silver moves in the opposite direction of the market in general, but not always. And so you don't have to go buy the physical assets. You can actually invest in funds. SLV is an exchange traded fund where you're investing in silver. GLD, and that's a fund where you're investing in gold. And so when COVID hit, for example, and there's bad news everywhere, the market's in a free fall, silver and gold went up. And so those are some things you can diversify in, that you can invest in to try to diversify. So you get the idea. You're trying to find things with a low correlation in order to diversify. Now, also, when you find stocks, a lot of stocks, their correlation coefficient isn't readily available. You'd have to calculate that. But if you look at the betas, a lot of stocks that have a low beta, some stocks like a REIT might have a negative beta, but stocks that have a very low beta tend to be good for diversification as well. Okay, so let's look at this example that they have. So in case one, these two stocks, you see stock A and stock B, they're perfectly positively correlated. They have a correlation of +1, meaning they're moving in the exact direction. So, if I could predict the future, I could just invest in these two stocks and just try to guess right or time it right and sell when they're going down and buy when they're going up, and I could make a lot of money. But I can't do that. So there's no point in investing in stock A and stock B. I get no diversification benefits. Here's my best situation if I can find this situation, which in reality is impossible to find. This is a perfectly negative correlation. Two investments moving in the opposite direction. So I'm basically guaranteed to make this certain amount of return. Of course, this is what typically happens, is you have stocks that have a partial correlation. The market in general has a correlation of 0.65%. So that would mean, to explain that, that's a partial correlation. So if one stock is up $1, the other one might be up 65 cents. If one's down $1, the other one would only be down 65 cents. So like I said, the market in general has a positive correlation. So it is hard to find stocks that are negatively correlated. But by investing in different industries, of course, you can gain these diversification benefits. Like, just to give you an example, yesterday, the oil, all the energy stocks were down, but all the tech stocks were up. Today, just the opposite happened. Energy was up and tech stocks sold off. And so that would be a good example of being diversified. But if you just buy the market in general, you can, with an exchange traded fund or an index fund, you can really get some good diversification benefits in addition to buying individual equities. Okay, so anyway, get back to this. This shows a partial diversification, this shows a partial correlation. And so you get some diversification benefits of owning these two. Okay, so case one, perfectly positively correlated, no diversification benefits there. Case two, perfectly negatively correlated. And so you get, you're getting your maximum benefits from correlation. And then in case three, you have a positive correlation, somewhat positive, but you're reducing your risk somewhat by by investing in that portfolio. All right, we can skip that. All right, so this is when we talk about portfolio theory, researchers have come up with this efficient frontier. And so basically what they're saying here is that we're talking about risk and return. If we go back here, we look at expected return and the risk. And so what they're saying here is that as your risk increases, as the standard deviation increases, you should expect your return to increase. So in B, this is along the efficient frontier. This is obtainable, this investment B. So as the risk increases, your return increases. And so with B, you've got this amount of risk and this amount of return. Here, this is not a good investment because you see you're not getting the return that you should for your risk. You're at the same risk level here, but it's inefficient because you're not getting enough of a return. This is an excess return for the amount of risk. This is unattainable. So this is attainable and efficient. This is inefficient, and C is unattainable. And the efficient frontier is basically looks at your willingness to bear risk. And so if you're very risk averse and you don't want to take much risk at all, then you're going to require a lower return as you can see in that efficient frontier. Okay, so we're going to skip the indifference curves. It's just another way of explaining the relationship between risk and return. So I'm going to skip through these. Now the capital asset pricing model is again just a trade-off between risk and return. And they come up with this efficient frontier using this capital asset pricing model. So it's the same thing as this efficient frontier. Here's your standard deviation, here's your risk, here's your return. This is the risk-free rate. So what this is saying is if you invested in a CD, for example, certificate of deposit, you would make the risk-free rate, no risk at all. Now, if you're going to take on risk, you would increase your return. And so this Z here, this is efficient. This is where you have this amount of return and this amount of risk. And so if you have a portfolio and you plot your required return on the portfolio of your portfolio, you're going to have all these. It's going to basically trend along this line. You're going to have some that's low, some that's high, but basically you're going to be close to this efficient frontier or this capital market line. And we use the capital asset pricing model formula to plot our stocks, and they will trend along this line. So let's go to the capital asset pricing model. This is just showing how as you increase your risk, and showing you examples of the increased risk, you're going to have increased returns. So let me go to the capital asset pricing model. This is just explaining what I said before, how the market has a beta of 1. A beta greater than 1 means that the stock's return is more volatile than the market. A beta of less than 1 means the stock's return is less volatile than the market. Okay, here is the capital asset pricing model, which is calculating the required return. So K is the required return, and the required return is simply the risk-free rate, which would be given to you. It's let's say the rate on a CD, the rate that you can get on a risk-free investment, which would be a CD or a short-term government bond. So let's say that's 3%. Plus the return in the market, let's say that you think the return on the market's going to be 8%. So it's the return in the market minus the risk-free rate times the beta of your stock plus the risk-free rate. That's your required return. So if you had, let's say that the return on the market is 8% and the risk-free rate is 3%. And so if we took 8% minus 3%, that equals 5% right here. That's also called the risk premium, because if I invested in a stock, I would want to get that risk premium over and above my risk-free rate times the beta. So let's say that the market return is 8%. And remember, the market has a beta of 1. So let's just think about this example. So the return on the market is 8%. If we put that through this formula, it's going to come out to be 8%. 8% minus 3% is 5%, times a beta, market beta of 1 equals 5%, plus 3 is 8%. So the market has a required return of 8%. What if we had a stock with a beta of 2? What would the required return be? Well, given these assumptions, 8% minus 3% is 5%. 5% times a beta of 2 is 10%, and 10 plus 3 is 13%. So if we had a stock with a beta of 2, given those assumptions, the required return would be 13%. So just to repeat that, 8%, I'm just making these assumptions. Assume that the market return is 8% and the risk-free rate is 3%, and the beta for the stock is 2, twice as risky as the market. So you take 8 minus 3 is 5. 5 times 2 is 10. 10 plus 3 is 13%. So under those assumptions, a stock with a beta of 2 would have a required return of 13%. So then you can look on Yahoo or look in any other at any other site and see what analysts expect the return to be for that stock. If they expect the return to be 15% this year and your required return is 13%, the stock is a buy. It's undervalued because you're only requiring a return of 13% to be compensated for your risk. Now, if they think that stock is only going to return, say, 10%, and you're requiring a return of 13% to be compensated for your risk, the stock is overvalued and you shouldn't buy it because you're requiring a return of 13%, and the experts, so-called experts, are telling you they only think it's going to return 10%. So just to repeat, this is the capital asset pricing model, and it's the way we calculate the required return to see if a stock is undervalued or overvalued. All right, so and we can, as I said, you can plot your different required returns along the security market line. The security market line is telling you that for a certain beta, this is the required return. Okay, so that's basically it for this chapter. I'm not going to go over arbitrage pricing theory. So just remember, make sure you know the difference, but know about the capital asset pricing model, know the difference between the types of return and how we measure return using standard deviation and also beta. So the rest of this we're not going to cover in this course. Okay, I will see you next time. Goodbye.